This section on financial statement analysis will focus on Dupont Analysis. Okay, so why is it called Dupont Analysis? Because it's popularized by Dupont Corporation. Now, this is not a history lesson, no? So if you want to know more about how this method was developed, okay, there are a lot of references in the internet. But as of this point, hanggang dito lang muna tayo. Ayan. And then, this is a framework for evaluating performance. Now, Dupont analysis, no, has three basic metrics or components. First, you have your operating efficiency. Let me write that down. You have your operating efficiency, or simply efficiency lang, okay? And then, you also have leverage. Ayan. Leverage, and you have your profitability. Profitability. Actually, it depends, no? It depends on how you decompose your ROE or your Dupont analysis. Ayan, in some books there are 5 matrix, pero as of today dito lang muna tayo sa tatlong ito. And then we'll try to explain more as we go along. Now, Dupont analysis focuses on the basic components of ROE. Ayan, normally we compute your return on equity by dividing the net income with the stockholders equity. Okay po. So ayun, now when we say components, okay, in some books, no, it's not just components, sabi elements, may mga ganun pa sila, pero sa ngayon basta components lang. And then it's usually used for strategic planning rather than performance evaluation. So, hindi ba medyo opposing yung diniscuss mo? Sabi mo kanina is a framework for evaluating performance. Yes, originally, no, when it was developed. But because of the interrelationship, no, of the components, okay, most of the time, now in the industry, it's used for strategic planning. And later on, no, at the end of our discussion, we're going to try to integrate, no, Dupont analysis with the growth rate. Okay, so ito yung mga advancements daw, okay, sa Dupont discussions. Anyway, let's start. Okay, sabi natin, okay, Dupont analysis is basically a decomposition of your return on equity. Okay, so let's write that down. Your return on equity is normally computed by dividing the net income with your stockholders equity. This ratio is a measure, no? This is a measure of profitability. But then if you try to look at this, no, another way to understand your return on equity, okay, is by dividing your return on asset with the equity ratio. Now, if you try to look at this is a ratio on profitability. Now, what's the formula for return on asset? This one is net income divided by total assets or average total assets. If you go back to our previous discussions, every time we divide a nominal account with a real account, we use the average. So you can use your average total assets. Ganun din dito, average stockholders equity. Now your equity ratio can be computed by dividing your stockholders equity with your total assets. Ayan, now this one is further simplified, no? Going back to your basic math, if you're going to divide a ratio by another ratio, you simply multiply the reciprocal of that ratio. So another way to compute this will be return on asset, which is net income divided by total asset, okay, times, okay, 1 all over by equity ratio, which is equivalent to total asset divided by stockholders equity. Ayan. This is now what we call the equity multiplier. Oh, ayan. Now, just to emphasize the effect of leverage in DuPont, okay, another approach was developed, no, net income divided by total asset times, instead of getting this equity ratio, ang gagawin na natin is 1 divided by 1 minus your debt ratio. And pag nandyan na yung debt ratio, kaya ang tawag na natin dito ay financial leverage multiplier. Okay, so they are all the same. Okay, now as you can see, okay, your return on equity is now a ratio of asset efficiency, hindi pala asset efficiency, profitability and leverage. Now, your return on asset is further divided into two ratios. You have your net profit margin times your total asset turnover. So, how do you compute for your net profit margin? This is actually net income divided by sales, while your total asset turnover, this is your sales divided by your total assets. Okay? So, if you try to look at this, things will cancel out. Now, is this another way to compute for your return on asset or another way to compute for your return on equity? Well, yes, pero a better way to understand this type of analysis is, let's just say that this is another way to understand the components of your return on asset, or another way to understand the components of your return on equity. Now, if you try to look at this, you now have three basic elements. Now, you have your net profit margin, which is a measure of profitability, okay? Total asset turnover, which is a measure of asset efficiency, tama ba itong ginagawa ko? Ayan. And then this one is an indicator of leverage. Ayan. An indicator of leverage. Ito yung sinasabi natin kanina na elements or matrix, tama ba? Dimensions. So, bahala ka na kung ano yung gusto mong itawag doon. Okay? Of your return on equity. Okay? Profitability, asset efficiency, and you have leverage. Ayan. So, if you want to improve your, let's say, return on asset, okay, what are the basic components of return on asset? Profitability and asset efficiency. So, you have to increase your net profit margin, okay, or you have to improve your asset turnover. Ayan. And if you were able to improve your return on asset, definitely it will also improve your return on equity. Ayan. Another way to improve your return on equity is by improving your leverage. Okay po. So, ayan. Now, if you want to go further, okay, in our discussions, and break-even point, okay, and this is the reason why we have to discuss break-even point muna, or cost volume profit analysis, so you can appreciate Dupont analysis. But anyway, we're just following your curriculum, your syllabus. Another way to understand your net profit margin, ayan, is by dividing this into two components. You have your contribution margin ratio times the margin of safety ratio. Yan. If you want to improve your profitability, okay, you have to improve your contribution margin. What is contribution margin or contribution margin ratio? The contribution margin ratio is computed by dividing your contribution margin with your sales. And the higher the contribution margin, the better. Why? Because it will be easier for you to recover your fixed cost. Okay, it will be earlier to break even. Ayan. Or you will have more profits. Okay, so that's one. Now, your margin of safety is computed by first deducting from your current sales. Okay, you deduct from your current sales your break-even sales. That's the margin of safety. And then you divide that by your current sales. Your margin of safety is how much you're operating above your break-even sales. Okay, so this is actually where your net income will come. Okay, if you are operating above the break-even point, then definitely you will be incurring income. By how much? By your contribution margin ratio, because your contribution margin, okay, above the break-even point, okay, will go to your net income. And because at break-even point, all your fixed costs were already recovered. Okay, so ayan, how do you compute for your contribution margin? You have your sales, okay, sales minus your variable costs equals contribution or total contribution margin. Okay, so let's try to summarize. Okay, the focus of your Dupont analysis is the decomposition of return on equity. Under Dupont analysis, it's divided into three components. Okay, the profitability aspect, okay, as represented by the net profit margin, efficiency aspect as represented by your total asset turnover, and your leverage as represented by the financial leverage multiplier, which is just the reciprocal of your equity ratio. Okay po. Now, if you try to put that together, ayan, we can now say another way to compute or another way to understand your return on equity is you have your net profit margin times your total asset turnover times your financial leverage multiplier. Okay, or you can have another ratio or another approach, okay, which is my favorite. Okay, your return on equity is actually divided into two basic components. Muna, you have your return on asset, which is a measure of profitability, and financial leverage multiplier, which is an indicator of leverage. And then your return on asset can now be understood as a ratio which is composed of net profit margin, a ratio for profitability, okay, and you have your total asset turnover, which is a measure of asset efficiency. Okay, so that's your basic decomposition of your ROE. Now, if you want to go further, this is now contribution margin ratio. Ba't siya nawala? Contribution margin ratio times the margin of safety ratio. So, let's have an example. Let's just assume, let's assume that your net profit margin, total asset turnover, and what's the other one? You have your, let's say, equity. Yan. You have your equity ratio. Yan. Is as follows. Let's say your equity ratio is 40. Okay, so let's say that your equity ratio is 40%. Let's say your equity ratio is 40%. Your net profit margin is, let's say, 5%, and your total asset turnover, let's say that your total asset turnover is 3 times. Oh, ayan. And we are asked to compute for your return on equity. Okay, so let's try to put that down. Let's hope this works, no? Kasi inimbento ka lang yan, impromptu. Ayan, so if you have here your return on asset, and then you have here your financial leverage multiplier. Actually, my shortcut dyan, di ba? This, you are going to use this if you're going to multiply. But if you're going to divide, you simply divide that by your equity ratio. And I'm going to show you later. Now, your return on asset, okay, is computed by multiplying your net Oops, sorry. What happened? Ayan. Your net profit margin by your total asset turnover. So let's try to put that down. Okay, how much is your net profit margin? It's 5%. What is your total asset turnover? It's 3 times. Okay, what about your financial leverage multiplier? This is actually 1 divided by 1 minus, ay may equity ratio na pala dun, ano. Okay, anyway, we can just erase that. How do I erase this? Ayan. Okay, so you have 1 divided by equity ratio, which is 40 and 40%. Dapat 1 minus 60% yan. Anyway, so let's continue. Okay, so what's 5% times 3? This is now 15. And 15% times 1, okay, all over by 40, or you could simply divide that by 40%. Patay, wala akong calculator. Let's see, do I have an open calculator? Okay, yes, dito tayo. Cancel natin yan. So you have, magkano na po yan? 15%, no? So you have 15% divided by 0.4 equals 37.5%. So let's go back. And dito, so you have 37.5% as your ROE. So parang ganun po siya. Okay. Okay po. Now, how are you going to use this for planning? Okay, let's assume, no? Let's assume that the president or management, assuming my mathematics is correct, let's assume that management is not happy with 37.5%. Ayan. And they want to have an equity ratio of, let's say, they want to increase this to 40%. Ayan. So what are they going to do? Okay, they could increase your the return on asset or improve the financial leverage multiplier. Okay, how do they do that? Okay, by reducing the equity ratio, okay, resulting to higher debt ratio. And in our previous discussion, we already discussed the effect, no, of increasing the debt ratio in your profitability. Okay, or they could increase the net profit margin or improve the total asset turnover. So let's assume that after some meetings, okay, so ayan, they found out that they will not be able to increase the total asset turnover. They cannot increase the total asset turnover. Ayan, hanggang 3x lang sila. But they can increase the net profit margin up to 6%. So they can increase this up to 6%. Okay. So if this will remain at 3x, okay, and net profit margin can be increased up to 6%, then we expect that the return on asset can be increased to 18%. Okay. So now question: if you want to have a return on equity of 40% and your return on asset, okay, is 18%, how much should be the equity ratio, okay, or how much should be the debt ratio, so that this will be achieved? Okay, so let's try to analyze that. We're just basically looking for a number that if multiplied to 18%, it will yield us 40%. Okay po? So, let's try that. Okay. Okay. So, I need 40%. So, let's try to work back. Okay. So, 40, and divide this by 18%, you will have, ay, mali. Bakit ganun? Let's try to, ba't nawala na? Is it 30? 40 pala. 40. Where's my calculator? Ayun. Okay, so it should give us 222. Tama ba? 222.22. Ay, kasi multiply pala yung ginagawa natin. Wait lang, baka lalo pala kayong malito. What if we'll just use the shortcut? Okay, I'm going to put it here para mas madali. Okay, I want a return on equity of 40%. Okay, and another way to compute that is by getting the ROA. I prefer this approach. Ayan, divided by the equity ratio. Now, if my ROA is 18%, ayan, ano yung pang-divide ko sa 18%? Okay, so that I will get 40%. Okay? So, paano po yung mathematics niyan, di ba? Maraming nalilito dito. Pero, let's try to analyze this further using basic math. Okay? If ROA ayan, is divided by equity ratio, you will get ROE. Tama po ba? Tama, di ba? So, if you're going to divide that, another way to understand this, if we are looking for your equity ratio, is by simply dividing ROA, okay, divided by ROE equals your equity ratio. And to check if your answer is correct, your answer is correct, your return on asset should be equal to ROE times the equity ratio. Okay? So, tama po ba? So, what do we do next? Okay. If we are looking for the equity ratio, we are going to simply divide ROA by your ROE. Okay, so that will be 18% divided by 40%. Okay, let's try to do that. Ayan, 18 divided by 40% equals, your equity ratio should be 45%. Ayun, so this should be, what ayaw na? Ayan, this should be 45%. So, let's try to check if our answer is correct. 18 divided by 45, 18% divided by 0.45%, and it should give us 40%. Okay po, so now to answer the question, what should be the equity ratio? It should be 45%. And what should be the debt ratio? It will be 55. Ayan, 55%. And if you're looking for what is now your financial leverage multiplier, this will be 1 divided by 100%, or 1 minus the debt ratio, which is 0.55. Okay? So, or 1 divided by 0.45. So, let's try to do that. Okay? 1 divided by 0.45, and you should get 2.22. And that's now your financial leverage multiplier. Okay po. So, ayan. So, it's basically, paano ba? It gives us a guide, no? What are you going to manipulate? Are you going to improve on your profitability, asset management, or leverage? Okay, just to improve your return on equity. Now, this will also help us understand, no, some exceptions to the general rule. Okay? For example, we all know that the higher the net profit margin, the better, okay, for the company. But if a decision was made and it resulted to a lower, let's have another color for this. It resulted to to a lower net profit margin, okay, but it's coupled with a higher total asset turnover. And if you try to put this together, it resulted, no, overall, it resulted to a higher total asset or return on asset pala. Ayan. Then that decision is favorable. Why? Even if it resulted to a net profit margin that is lower, but as a whole, it resulted to a higher return on asset. Kumbaga parang parang alam niyo yung balancing act. Diba? So, ayan, bumaba nga yung net profit margin. Okay, pero mas malaki naman yung tinaas ng total asset turnover mo. Okay? So, basically, happy tayo dyan. Ayan. So, kahit na may mga ratios na bumaba dito, as long as, in the end, it will improve your return on equity, then that decision is favorable. Okay po? So, ayan. And because of this relationship, it can actually give you an idea how to work back. No? Like, for example, ayan nga. You want to have a 40% net profit margin. Okay, and this is the given 3x and 6x. What will be the required FLM? Okay, that's 2.22. Or what will be the required equity ratio or debt ratio? Or what if your equity ratio or debt ratio is given? Ayan. And there is a target total asset turnover. Okay. And your target return on equity. Perhaps the problem may be asking you how much should be the minimum net profit margin so that the target return on equity will be achieved. Okay, so that's one way on how you can use your Dupont analysis in planning. Now, using that, using that approach, there are other approaches in the internet. Okay, we call it expansions, and there are different expansions. I'll show you some of the common expansions. Anyway, this one, what we did here last time, is already considered an expansion, because from one ratio you ended up with 3 or 1, 2, 3, 4 ratios. This time, okay, let's have more. Yan, expand lang tayo ng expand. Okay, your ROE can be understood as, tingnan ko nga kung naaalala ko pa. Ayan. Ano ba yung mga nasa dulo natin dito? You have your financial leverage multiplier, and then you're going to multiply that with your return on asset, and then we're going to divide your return on asset. Meron tayong tinatawag na you have your sales divided by total assets. Okay, this is your total asset turnover, and then you can have another ratio which is gross margin divided by your sales, also known as cost of goods sold coverage. This one will tell you how much of your total assets, how much of your total assets can generate sales, or how many sales can you generate for every 1 peso of your total asset. This ratio will give us an idea how much gross profit can you generate for every 1 peso of your sales. Okay, so that's after deducting your cost of goods sold. Okay, and then you also have your operating profit. Let's just use EBIT. I prefer EBIT. EBIT divided by gross margin. How much of your gross margin or gross profit, how much of your gross profit, okay, will go to your operating profit, or how much for every 1 peso of your gross profit, okay, will contribute to your operating profits. Actually, there's another way to expand this, expand this. Let me just write it here, okay, para hindi tayo malito. If you're going to consider the effect of your fixed cost, you can have EBIT and EBIT divided by EBITDA, okay, times your EBITDA divided by your gross margin. As you can see, magka-cancel out tong dalawang to, and you will be left with EBIT divided by gross margin. Okay? So, I think this one is your fixed cost coverage. Okay, and then this is now your how much of your gross margin or gross profit, or for every 1 peso of your gross profit or gross margin, how much EBITDA can it generate? What is EBITDA? This is earnings before interest, taxes, depreciation, and amortization. Okay? So, ayun, pare-parehas lang yan. Anyway, there's more. Okay? Here you have your EBIT. No, it's not EBIT. It's just EBT. EBT divided by EBIT. Okay, what's the difference of this? It's your interest. How much of your earnings before interest and taxes will generate interest before taxes? This is also known as your interest coverage ratio. Okay, and then you have your net income divided by EBT, also known as your tax coverage ratio. Okay po, how much of your earnings before taxes will go to your net income after taxes? Okay, ayan. If you try to look at these ratios, you can actually cancel some. This one can be cancelled. This one can be cancelled. If you try to multiply that, okay, tapos, yes, this one. And this one. If you try to look at this is actually just one ratio. This is your net income divided by sales, which is your net profit margin. O, di ba? Pinahaba lang. So, you have the net profit margin, you have the total asset turnover, and then you have your financial leverage multiplier. Okay. Now, in some books, they also have a different expansion for this. Okay, your net profit margin, another way to compute this is by dividing your net income with your contribution margin, okay, and then you multiply that by your contribution margin divided by your sales. This is your contribution margin ratio, and then this one is how much of your contribution margin will go to your net income. Ayan, fixed cost coverage naman yung tawag nila dito. Okay, now we normally use this ratio, and we normally use this ratio for cost volume profit analysis. Okay, but for planning purposes, I prefer using or expanding net profit margin into yung gaya kanina. You have your contribution margin ratio, okay, times your margin of safety ratio. Okay po, so those are the basic expansion. And of course, there are more. Anyway, okay, the favorite part of this discussion, para sa akin lang, is when you integrate this type of analysis in computing the growth rate. This is one of the common questions that I get, not just from students. Let me write that down. Growth rate. Not just from students, but also from clients. Sir, paano ba yan? There are a lot of ratios to consider. Can we just have one or two numbers to analyze? Okay, because it's so hard to evaluate if there are too much numbers. Ganon sila. Syempre, ang mga tao tamad. Buti na lang tamad ang mga tao. Kaya you can develop something new out of katamaran. Oo nga, pwede bang konting konting ratios na lang? Like for example, instead of analyzing ROA, net profit margin, and financial leverage, why don't you just go directly to return on equity? But then again, that is only a part, no? A part of financial performance. There are other aspects to consider. Now, if you try to read other books, especially the book of Gitman, no, in investment management, this ratio was introduced. Growth rate, okay? And growth rate is computed by multiplying the retention rate, okay, also known as your plowback. Okay, also known as your plowback or retention rate. There are a lot of formulas for the plowback ratio, but the easiest will be, ito yung na-discover ko, it's just 1 minus the dividend payout. And we will go back to that soon. Okay, so you have the retention rate or plowback. This ratio indicates how much will be left to the company after paying the dividends. Okay, because ayan, that's why it's 1 minus the dividend payout. The dividend payout is how much you are giving, no, to your investors. One way to compute for your dividend payout is you have your dividends per share divided by earnings per share. As much as possible, no, we want to get our share in the earnings. But if the company will give us all the dividends, what will happen? Nothing will be left to the company. Okay, they will have no funds to use for their operation and expansion. And if that's the case, the growth rate will be low or it will stop. Ayan. That's why the growth rate is dependent on how much will be retained by the company. So the higher the retention rate, the higher will be the growth rate for the company. Now there's another element. Okay, so you have the retention rate. You multiply that by your return on equity. Diba? Which is what? Affected by financial leverage multiplier. You multiply that by your return on asset. And another way to compute that, let's just review. You have the net profit margin. Multiply that by your total asset turnover. Let's expand this some more. Okay, you can have your contribution margin ratio. You multiply that by your margin of safety ratio. What's margin of safety ratio again? This is how much you're operating above the break-even point. Contribution margin, this is how much is left, no, after deducting your variable cost. This is actually the amount that you are going to use to recover your fixed cost, okay? And whatever is left, it will go to your net income. Now, let's go back to the other side. Okay? This is the formula for your retention rate. Now, let's talk about your dividend payout. Okay? How much is given out for every 1 peso of your earnings? Another way to compute that is by multiplying your price earnings. Another way to compute or another way to understand the dividend payout is price earnings times your dividend yield. What's the formula for your price earnings? This is computed by dividing the market value of your stock, not divided by the earnings per share. While the dividend yield, okay, is computed by dividing the dividends per share with the market value of your stock. O, diba? Ang saya-saya. Now, let's try to emphasize some things. If you multiply these two, you will cancel out the market value and you will be left with dividends per share and earnings per share. Okay? So, and alam na natin yung expansion dito. So, the thing about this type of expansion, this one has something to do with the performance of the company, okay, which is related to factors that, well, they can somehow control, no? Mostly internal factors yan. So you have the net profit margin, leverage, and you have your efficiency. This one, okay, what's unique about this part right here is the presence of market value. Why? Because as we all know, the market value of the stock is dictated, let's go back to economics, is dictated by the interrelationship of the demand and supply. Tama po, this is your equilibrium point. And at this point, you now have the price or the market value of a commodity, which also applies in our stocks. This one, the company cannot control this. Well, actually, there are times when you can influence this, but actually, you cannot control this. Okay po, so ayan, internal factors, external factors, you now have your growth rate. And the higher the growth rate, the better. Now, you can actually forget the other ratios. Even if some of them are unfavorable, some of them are favorable, but if you try to put them together, the net effect will be a better growth rate. Okay po, so I guess that's it. And thank you.